Well, been looking at the COMEX Commitment of Traders report, the largest open interest I think to date, especially for silver, is taking place. Open interest meaning how many outstanding contracts are there. Today, right this second, I should say, is Tuesday, so we're looking at tomorrow, I believe, is options expiration, end of the month. So, that's historically been a time the club likes to do a number on silver. I'm going to read you this article from dollarcollapse.com, John Rubino. And he mentioned something about Andrew Maguire as well. I'll link this from Zero Hedge in case you want to read this and or listen to Andrew Maguire's interview from King World News. Keeping in mind, he was in the pits, so to speak, in London metals market, and knew, because he knew some other traders, namely JP Morgan traders, that pretty much would tell everybody over there, we're going to crush the market today when the non-farm payroll stats come out, or we're going to crush the market today when the unemployment numbers come out, whatever it is. That was their sign. He did tell the CFTC the exact times they would crush the market. And as you know, the CFTC did this huge investigation. It lasted a few years and didn't see anything, can't find anything. And speaking of that, just to give you an idea of what the CFTC really is, again, it's bankers' friends running a regulatory agency. U.S. commodity regulator was unaware about Deutsche Bank's gold rigging until 10 days later. Almost 2 weeks ago, on April 14th, we reported, Zero Hedge, the striking news that Deutsche Bank had decided to turn against the precious metals manipulation cartel by first settling long-running silver and gold price-fixing lawsuits, which, in addition to valuable monetary consideration, would expose the other banks' rigging after Deutsche Bank also agreed to provide cooperation to plaintiffs, including the production of instant messages and other electronic communications as part of the settlement. And again, I already said what my opinion was on that. They're going to hand it all over, and they're going to go through it and say, well, there's nothing really here. It looks like Deutsche Bank was the sole bad guy on this one. I could just see this a mile away. If Deutsche Bank really turns on the club and rats them out, come on, that's not how they roll. I will be shocked if that happens. It was then that we also reminded readers that the U.S. commodity regulator, CFTC, in 2013 closed its 5-year investigation concerning allegations that the biggest bullion banks manipulate silver markets and prices. It proudly reported in September 2013 that it found no evidence of wrongdoing and dropped the probe. We concluded by asking whether, in light of this confirmation that the CFTC's probe was lacking, perhaps it was time for the so-called regulators, who at the time was headed by ex-Goldmanite, Goldman Sachs, Gary Gensler, and assisted by the revolving door expert at high-frequency trading lobby sellout Bart Chilton, to reopen its investigation. Much to our surprise, we found that the CFTC not only was not planning on reopening its investigation, but that it had actually not heard about the settlement until nearly 10 days later. This is what Chris Powell, treasurer of Gold Gata, which has been crusading against precious metals manipulation for years, wrote. CFTC didn't know of Deutsche Bank's market rigging settlement until asked by Gata. Since the CFTC has jurisdiction over the U.S. commodity futures markets, and since the commission purported to have undertaken a 5-year investigation of the silver market, closing it in September 2013 upon concluding that there was no cause for action, it was natural to seek comment from the commission about the Deutsche Bank news. So on Saturday, April 16th, your secretary/treasurer emailed the commission's news media office as follows, providing the internet link to the Bloomberg news report. Quote, does the commission have any reaction to Deutsche Bank's admission to manipulating the gold and silver markets, as reported by Bloomberg News this week. Is the commission responding to Deutsche Bank's admission in any way? As you may recall, some years ago, the commission reported that it had investigated the silver market and had found nothing improper. Is the commission reconsidering that conclusion? End quote. Receiving no response on Tuesday, April 19th, your secretary/treasurer sent by fax machine, for those of you that don't remember that word, a letter to the office of the chairman of the CFTC, Tim Masad, reading, quote, "As I am unable to get any acknowledgement from your commission's press office, could you answer my questions here? Does the commission have any reaction to Deutsche Bank's admission to manipulating the gold and silver markets, as reported by various news organizations last week? Is the commission responding to Deutsche Bank's admission in any way? As you may recall, some years ago, the commission reported that it had investigated the silver market and found nothing improper. Is the commission reconsidering that conclusion? Thanks for your help." Having received no acknowledgement of that letter as well, yesterday, which is a couple days ago, Friday, April 22nd, your secretary/treasurer telephoned the CFTC's press office and within a half hour of leaving a message, received a cordial call back from an assistant to the director. He said he was unaware of the Deutsche Bank story and could find no reference to it in the commission's compendium of news reports of interest to the commission's work. Your secretary/treasurer conceded that the story is being largely suppressed by financial Western news organizations and sent him the links to the Reuters and Bloomberg stories, as well as a link to the original complaint in the class action lawsuit. He said he would consult his superiors and hoped to reply to me next week. Of course, all this gives the impression that the CFTC not only doesn't know what's going on in its jurisdiction, but also that it doesn't want to know. It is additional evidence that certain commodity market rigging is outside the Commission's concern because the U.S. government and other governments are the actual perpetrators. Surreptitious market rigging by the government being specifically authorized by the Gold Exchange Act of 1934 as amended in the 1970s. And they link to this, so I think I'll link you this side as well. This link to Zero Hedge, so I'm going to give you two links. A little bonus for you. And because of the admission in recent official filings by CME Group, operator of the major U.S. futures exchanges, that it provides volume trading discounts to governments and central banks for surreptitiously trading all futures contracts on its exchanges. All this also seems to confirm that the prerequisites of this market rigging are the cowardice of the monetary metals mining industry, which refuses to protest it, and the cowardice of mainstream financial news organizations, which refuse to report it. So, as it stands, there's a lot of, as far as hedge funds go, a lot of them are, the charts are showing, a whole bunch of them are net long on silver. Not so many net short. So they've switched. Once again, commercial banks, you know what their position is, short the living hell out of it. So we have record-breaking number of contracts out there, paper of course. Hedge funds and those bozos usually, because they always make the wrong move normally, are betting that the price is going to keep skyrocketing. The commercials, again, which are the banks, are betting the opposite. And it's those commercials who own the entire paper market. They have a massive amount of contracts that they own. And even if they don't own a bunch of them, all they, or the lion's share, all they have to do, again, this is all electronic, is sell off a whole bunch. Left hand sells off. So let's say JP Morgan. Right hand, HSBC, buys it. It's all predetermined. So they flood the market. Price comes down. Once it hits a certain price point that they need, HSBC, and again, just an example, comes in and buys them all up to keep that price right there. There's not enough hedge funds, there's not enough small speculators, there's not enough large speculators to take up those contracts, which is why the banks have the majority of those contracts. As long as they have the majority of them, they can push the market left hand back to the right hand back to the left hand. It doesn't matter. So the question is, which by the time you see this video, we'll be probably taking a peek tomorrow morning as the markets open, precious metals markets, just exactly what happened. So I want to read you this original story. That was what I started on, and just kind of sit back and say, let's see what happens. John Rubino from the dollarcollapse.com website. For as long as most gold and silver investors can remember, the paper markets, that is, banks and speculators placing bets with futures contracts, have set the price of those metals. And within the paper markets, the commercials, or big banks, which he calls the fabricators and big banks, have consistently fooled speculators like hedge funds into going long or short at exactly the wrong time. The data series that tracks this relationship is known as the COT report, or Commitment of Traders. And it's been a pretty reliable indicator of precious metals' short-term trajectory. Right now, that's bad news for gold and especially for silver, because the speculators, who, remember, are usually wrong at the extremes, are exuberantly long the latter, implying that the silver recovery is due for a correction. Here's a recent piece from well-known metals trader Dan Norsini. And he says, silver commitments of traders. Is Halloween arriving early this year? By that, I mean it just keeps getting scarier and scarier. My guess is that every speculator on the planet is long silver and short gold, or just outright long silver. That, of course, is an exaggeration, but I am not exaggerating when I categorically state that the silver market is a train wreck waiting to happen. As I've said before, and I will say so again, I would rather miss any more upside in this market than get long now, not with the trade so lopsidedly jammed with speculators on the long side. I will leave that for the daredevils and others who like driving the stagecoach as close to the edge of the mountain pass road as they possibly can. So he shows a chart here basically, and it's just what I said. It shows a lot more people, hedge funds, going long versus going short. There's a significant amount more going long. Yet another all-time record high. Tell me we do not have a buying frenzy taking place in the silver market. I suppose it can keep going higher and the specs can keep piling on more and more longs, but when it breaks, it's going to be ugly. Unless you are short, and then it will be a thing of beauty to behold a mass exodus of hapless specs who ended up buying the top in this thing. Commercial interests and swap dealers have been more than happy to offload silver into the hands of speculators at these prices. If I were long this market, and I am not, I would get some downside protection through the use of options at the very least. On the other side of this argument is London metals trader Andrew Maguire, who in his latest interview on King World News asserts that gold and silver are now entering new post-paper age in which physical demand sets the prices. And I will say this before I continue reading what he's saying. I knew this was going to happen. I've talked about this numerous times. But that doesn't mean that right now, today, tomorrow, the next day, near future, that the club can't lob a grenade, so to speak, on the markets. They still set the price on the COMEX paper markets. They still have the control. Doesn't matter that Deutsche Bank said, we're going to work with you. We did rig it. They still are using that mechanism to rig the prices. So we could very well see a waterfall drop-off tomorrow. But if we don't, it's going to leave a whole lot of people, and I shouldn't say just tomorrow, up until, because there's first day notice, last day notice, and all that stuff with options expiration. So how about the rest of this week? Let's call it the rest of this week. If I don't see a dropping, as in precious metals end the day in the red, and not just a few a few points, as in silver's down, 5 cents, or gold's down $4. I'm talking, gold's down 20, 25, 30 bucks, 40 bucks. Silver's down, 30, 40 cents. That would be the club. Having said that, If I see the very next day, after such an event happens, oh, never mind, it wiped it off again. It's back up to where it was. Oh, gold's back up to where it was. Silver's right back where it was. You have to start thinking about what some of these guys are saying, like Andrew Maguire. Why else would these prices bounce right back? What would be absolutely amazing to me is if, even if they try to smash it, let's say tomorrow, which again, you're going to be reading this tomorrow or watching this video tomorrow, they smash it. Oh my God, it's in the red. And then by the end of the day, oh my God, it's back in the green. Like it just wipes it off. That would be fantastic to see. All I know is there's going to be some interesting times. Hold on tight. Keep stacking your silver. And let me finish this because it's almost done. Western central planners have finally lost control of the gold market. And this is part of what he talks about, Andrew Maguire. There is an unprecedented liquidity drain out of London markets into physical markets in the East. Keeping in mind, China let that physical gold market open up recently, right? That exchange. And we've seen nothing but rising prices in both silver and gold day after day after day since this happened. It's flowing out of the paper market into the physical exchanges. These events are unprecedented, forcing changes in the behavior of paper markets that are not comprehended by paper-centric analysts who are puzzled, I should say, over outdated chart patterns in synthetically extracted data. Just this week, things came to a head. An overwhelming number of bearish observations appeared in the blogosphere. I see a lot of hand-wringing about open interest structure, which historically at these levels has resulted in a major rinse lower. In other words, waterfall drop-off in the price. But the gold market is increasingly driven by global physical benchmarks. The physical market dog is starting to wag the paper market tail. Anyone trading paper-centric historical patterns is driving forward while looking in the rearview mirror. Maguire goes on to say that if this is indeed the long-awaited physical takeover of the precious metals markets, silver will not only fail to correct, in other words, they're going to smash it and it stays smashed for a little while. In other words, either that doesn't even happen, it just keeps going up, or B, it smashes and again, like I said, it comes right back up. So he says that if this is indeed the long-awaited physical takeover of the precious metals markets, silver will not only fail to correct, it will go up faster than gold, bringing the gold-to-silver ratio down to more historically normal levels. That's interesting that he's saying that because how long has the Webbot, in the last several reports, referred to silver to gold ratio coming back down, coming down even more, coming down even more. And keywords surrounding silver, things like panic to own. Cannot get any. Panic. Panic to own silver. Those are the types of keywords. And there's a bunch of other ones. I can't remember. Again, this was at least a few months ago when I first started seeing those words being reported in the Webbot report. But it was similar words. Panic to own, can't get any, trying to get some, whatever. So if that's the case, and this is the right timing, then maybe what he's talking about as a possibility may actually happen. For those getting back into precious metals after the brutal bear market of the past few years, the prospect of the Eastern, again that's Asia, China, physical markets taking over from the Western paper markets is welcome. But it adds another layer of complexity to an already opaque market. So here again, the only rational response is to embrace the short-term uncertainty and dollar cost average. Since both camps in the above debate see precious metals much higher a few years, hence just buy a little at a time and don't try to play the squiggles. Leave that to the pros. So what he is saying is, I'm a buyer today, I'm a buyer tomorrow, I'm a buyer the next day, and I was also a buyer last week. I'm not sitting back, well, let's see what they're going to slam in, am I going to jump in? No. The price rise too quick, let me get in now. Nope. Don't pay attention to that. Keep stacking. It's going to happen. Is it going to happen right now, today, the next day? We're about to find out. Is it about to shrug off the largest open interest ever in silver? Gold, again, it happens to gold and silver at the same time. Gold smashes, silver smash. Gold rises, silver rises. I mean, it's pretty much hand in hand. But when I read stuff like this, and then think of just a few months ago Webbot reports, and then more recent Webbot reports talking about this kind of thing, saying silver's going to be lifting off and whatnot, makes one wonder, doesn't it? So we will see what happens. Take care.